مرحبا يا إخوان، حياكم الله مرة ثانية معنا. والآن نبدأ بالكلمات، واللي هي كلمات الاختصاص في المجالات الاكتوارية وكل ضمن اختصاصه. فأول كلمة ستكون للأستاذ كريس ديكن، نرجو أن نستفيد منها إن شاء الله قدر المستطاع.
Thank you very much, Chairman. It's a pleasure for me to participate in this conference and to give you, by way of an overview, some ideas about the development of Social Security and pension funds, reflecting what is happening in various parts of the world. I cannot claim to be an expert on your own situation here, and I leave it to you to apply these ideas in the context of your own country, although my colleagues have had the pleasure of working with the Bahraini Social Security and other social security organizations in the region, and we look forward to developing that relationship in the future. You'll find copies of the slides in your conference pack, and also copies of a paper which my colleague David Lewis and I presented to the Institute of Actuaries just over a year ago, which goes by this title of A Crisis of Longer Life. And people have criticized us for using this terminology. They say, why should longer life be a crisis? Surely that is a blessing, something we should be thankful for. Well, from the individual point of view, yes, surely it is. But from the point of view of the finances of Social Security and healthcare also, people living longer presents challenges, perhaps we should say. Rather than problems, it presents challenges which need to be addressed, and addressed in good time. Because although there has been much discussion about the aging of the population, even in the more advanced demographic situations that we have in some European countries, the big problem is still some years away. In your country it's probably even further away, but it's as well to plan a long time ahead. And if you can say one thing about actuaries, it's that they have a long-term perspective, and they like to think well into the future, and that's the perspective which I hope we can bring today. Now, some of the problems or challenges that are faced by Social Security schemes around the world include this issue of population aging, which I will come back to, but they also partly relate to the fact that Social Security schemes are maturing. Many of them have not been going for all that many years, and it takes time for them to work through to the whole population, and for the whole elderly population to be in receipt of a pension reflecting a full working life. Unless you put in place some special arrangements to accelerate that process, it can take 50 or more years for a scheme to develop all the way through to maturity. Also, I think people are becoming increasingly concerned that retirement age may be set a little low in some countries compared to the period of time for which people can expect to live. And there is this balance to be reached between how long people should remain in the workforce and how long they should be in the retired part of the population. And that is an issue which is increasingly discussed in many countries. And then some Social Security schemes have suffered particularly from periods of adverse economic circumstances, with higher inflation perhaps, or higher unemployment over periods, and that has put stresses and strains on the financing of Social Security schemes. Others face problems because they were not perhaps designed very cleverly in the first place, and they have some issues arising over people claiming benefits which are out of proportion to the contributions that they have made in various different ways. Now, this slide gives an indication of one side of the demographic issue, and that is the falling level of births, what technically we call fertility rates. Nothing really directly to do with fertility as such. It's to do with the number of births that are produced per woman in the population, and as a result mainly of social and economic factors, this has been falling in most countries over the recent past in particular. And the scale of this doesn't work terribly well, because I've tried to put onto this slide the top line, the yellow line with triangles on it, an indication of the fertility levels in what the United Nations statisticians call Western Asia, which includes this region, the Gulf, the Middle East, and so on. And you can see from that that the fertility level in this region is still significantly higher than in the European countries that are bunched down towards the bottom there, and that includes, the United States and Japan within that group. But those countries all have rather similar fertility rates. But what is notable, I think, is that the fertility has been falling everywhere, and it's fallen proportionately just as much in the Western Asian region as elsewhere. And you can see it's fallen dramatically from 6 in 1960 down to about 3.5 or 3 now in the foreseeable future, in the early part of the next century. And so the same tendency is taking place a little bit behind what has happened elsewhere, where the main falls took place in the 1960s and 1970s, and there has now been some stabilization. But if you think of this from the point of view of the European and American situation, the fertility levels that are shown there are below 2.0, which means that there are fewer babies being born that are necessary to keep the population at a stable level. And in due course that will be reflected in falling population numbers in total, as opposed to previous experience of growing populations. Now, you're a long way from that happening in this region, but nevertheless the tendency is still in the same direction. Now, at the other end of the demographic spectrum is the length of people's lifetimes, and one measure of that is the expectation of life at birth, which is the expected number of years on average that people live from the time they're born until they die. And this is usually measured on the basis of work done to produce what actuaries call mortality tables, based on the experience at particular points in time. And this shows what happens if you look at that experience in different countries in 1950, 1970, 1990, and what we think might be the case in 2010. And you see this steady increase in the expectation of life. For most of the European countries, this means increasing from around 65, the 1950 point, up to about 75 by 2010, which is quite an appreciable extension to the average period of life. For the Western Asian region, the expectation of life in 1950 was quite low, in fact off the bottom of this graph, and you see this line coming up from the bottom, which reflects the Western Asian experience, has actually been getting better much faster than other countries, and rapidly catching up the other parts of the world, so that by 2010 the differential between Western Asia and other countries in Europe, for example, has become relatively modest. And the same will be true if we look at the female situation, which I think I may have missed out that slide. We come on now to the so-called dependency ratios, which are a measure used by demographers to reflect the relationship between the number of people in the working population to those in the retired population. And in fact, this is the ratio of the number of people over retirement age to the number of people deemed to be in the ages of work. And it can be done more sophisticated ways, allowing for activity rates of those in work. But this is just based on the population numbers. And here you can see an increase reflects a greater level of dependency. So as this graph goes up, that reflects the fact that there are more people over retirement age relative to the number of people who are of working age. And that increase is happening already to some extent, but really the main increase takes place after 2010, even for the main European countries, and it's in that period between 2010 and 2030 that you see dramatic increases in the dependency ratio taking place. And these are particularly strong in a country like Japan, for example, which has particularly low fertility and particularly high expectation of life. Now, on this scale, the situation in Western Asia, which is the bottom line, it does not show the same degree of deterioration as is taking place in other countries, and this is because it is at a much earlier stage in the demographic development, and these aging situations will arise in later years, not on the timescale shown in this graph. However, there are some important things taking place in the age structure in Western Asia, which are particularly evidenced by this slide, where you'll find Western Asia appearing as the second of the bars from the left-hand side. And this slide shows the percentage increase in the number of people over the age of 65 over a 20-year period from 1990 to 2010. And this shows that of all the regions in the world, the Western Asian region is perhaps experiencing one of the fastest growths of the numbers of elderly people. And the fact that the dependency ratio still looks quite low reflects the fact that you still have quite a young population, reflecting larger numbers of births in the past and in recent years, and a relatively small elderly population, reflecting the smaller numbers in the population some years back. But now the numbers of elderly are growing rapidly, and more rapidly than in many places around the world. Now, one of the consequences of this for the social security schemes is that the basis of financing of most social security schemes around the world is the pay-as-you-go principle, which means that to a large extent the benefits to the beneficiaries of today are paid for by the contributions that are made today by the employers and the employees and the government. And in many social security schemes, there is relatively little attempt made to build up funds to provide for the future. They are operating almost on a day-to-day or year-to-year basis in terms of collecting money in and paying it out. Now, in your situation, particularly here in Bahrain, there is a fund building up because there is thought of planning for the future and making some provision for future years. And that's something which a number of social security schemes are now trying to do. But what they are facing is a quite marked increase in the cost of Social Security over coming years. And this, you can appreciate, has a major potential impact on the economy of some countries. And this graph is, this table is prepared from a report by the International Monetary Fund, which looked at the contributions necessary today, or at a recent date, to pay for the benefits under Social Security schemes in different countries as a percentage of the economy measured by the gross domestic product, the GDP. And that's what you see in the center column there, that in a country like France, for example, they have 12% of the GDP needed to pay the benefits under the Social Security arrangements in 1995. In the UK and the United States, it's much lower. You'll see there about 4%, 4 to 5%, and that reflects a very different structure of Social Security in those countries, with much more emphasis being placed on the activities of the private sector through pension plans and insurance arrangements, which are, generally speaking, funded pension plans as compared to the government-based pay-as-you-go Social Security. Whereas in France and Italy and Germany, countries with the big numbers in that column, there is relatively little activity by the private sector and much more dependence on provision by the state Social Security. But I don't want to focus particularly on that so much as the difference between that column and the next column. And the next column is the same sort of concept, the contribution necessary for meeting the cost of the Social Security benefits, but it represents the average cost over the next 50 years. So it's looking ahead quite a long way, up to 2050, and taking the average cost over that period. And you can then compare that column with the previous column and see that in the case of many of these countries, particularly France, Italy, Germany, and also to slightly lesser extent perhaps Japan, there is a big increase of around 3% of the gross domestic product between the cost now, or just recently, and the average cost over the next 50 years. And that means that over the whole of the next 50 years, these countries are going to have to put aside, on average, 3% of their gross domestic product just to finance the growing costs of their Social Security schemes. And you can imagine the consternation that this is causing amongst the ministers of finance and the ministries of finance and economics in those countries, to see that amount of their national product being already preempted by the promises made under Social Security plans. And you may say, well, why didn't they realize this earlier? And the fact is that some of these countries have not had a tradition of producing long-term actuarial projections to display the long-term costs of the Social Security scheme. And in other cases, one must say that it was perhaps more the political situation and the political imperative of giving benefits and promises to people which led to that having preeminence over thinking about the long term. And so the message, I think, to draw from this is that managing a Social Security scheme requires very long-term thinking, and it's not just a question of making promises today, which are easy to make and maybe not even very costly to deliver in the immediate future, but which can nevertheless have big consequences in the longer term. And the role of the actuarial review, which later speakers will focus on, is to draw attention to the long-term implications of what is happening in the scheme, and when you think of making changes, what will the implication of that be, not just today or even 10 years down the line, but in 40, 50 or 60 years from today. Well, as a result of these quite complex and worrying problems facing social security schemes, there has been a huge debate on the future of social security taking place around the world. And this takes place both at the level of individual countries, governments, media, employers, employees, professionals, but also at the level of the international bodies such as the World Bank, and the International Monetary Fund, the International Labour Organization, and not least the ISA, the International Social Security Association. And these debates rage around the possible ways of addressing these problems and are often dominated, it's perhaps disappointing to say, by people's ideologies. Maybe that's inevitable, that people come from a particular standpoint, and that reflects in the way in which they approach the problem. And I think personally it's important to be very open in discussing these matters and to seek solutions which are appropriate for the particular countries, and that will be different perhaps in each country according to their social makeup and their background, their economic situation, and so on. Well, the simplest and most traditional solution to rising benefit costs in social security has been to put up the contribution level, and that has happened in many social security schemes. Over the period of maturity, the scheme becomes more expensive. You have to put up the contributions that the employees pay and the employers pay. Otherwise, you may have to provide some additional financing from the government. That means, in the end, somebody has to pay for it. It has to come out of other tax revenues, which very often then goes back to charging companies and employees more in other forms other than the contributions for social security. But if one doesn't think that it's realistic to go on doing that indefinitely into the future as these costs get higher and higher, then you have to start looking at other aspects of the solution. And the other side of the coin, so to speak, is to look at the benefits and to see whether it's possible to cut back the benefits in some way. And we'll look in a moment at some of the options in that area, but generally speaking, that's not a politically attractive solution, because that means changing the promises that have been made to individuals, and that's something which politicians would be loath to do. Another possibility is to raise retirement age, and this is perhaps an increasingly realistic prospect in many countries, because people are becoming aware of the longevity situation. People would even like to work longer in many countries because they fear being given early retirement and being pushed out of the workforce, because many people find great fulfillment through their work, and also, generally speaking, are remunerated more when they are working than when they are receiving a pension. And so people in many places would like to work longer and would appreciate the opportunity of higher retirement age. Of course, it does raise problems about whether the economy will sustain higher numbers of people in employment, and whether the raising of the retirement age would have an impact on activity rates at younger ages, maybe even increasing unemployment. Another aspect to this whole nexus of solutions comes from looking at the development of complementary pension provision. And by this I mean different forms of private pension arrangement, either organised by employers or organised by financial institutions or by other mutual bodies to provide for people's retirement through other financing mechanisms. and we'll look at some of the ways in which that can be done in the rest of this lecture. Now, if we look at the benefit side of the social security scheme, we find many countries looking to make changes to the long-term cost of the benefits without, as far as possible, affecting the benefits payable to people in the short term, because you don't really want to make cuts in the benefits payable today to pensioners, or indeed to make cuts in the promises that have been made to people as regards the benefits that they have built up so far during their working life. So most of the solutions, if they are solutions in this area, tend to be ones which will have a long-term impact on the cost of the scheme. And one of those is to look at the way in which the benefits are calculated. For example, how many years do you average over in order to arrive at the pension? How do you index the pension benefit once it comes into payment? Is it linked to the price index or earnings index or whatever? Can you make it more difficult for people to qualify for a full pension by extending the period of qualification for a pension? And can you make it harder for people to take early retirement? Because one aspect of the retirement age problem is the fact that in many countries it's possible to take retirement before the normal retirement age and to receive possibly a reduced pension, but in many cases that's still an expensive option for the social security scheme if people retire early and take that option. And that includes the impact of disability pensions, which is an important topic in its own right, and where many countries around the world have seen increasing numbers of people on disability pensions, not, I believe, because people are more incapacitated than they were in earlier years, but because there is a greater awareness of incapacity, a greater willingness for people to seek exit from the labour market on incapacity grounds. In some countries also a greater willingness of doctors to say that people are incapacitated, and also in many countries, particularly we've seen it in some European countries, a willingness on the part of employers to use incapacity retirement as a way of giving people early retirement to get people out of the workforce rather than making them unemployed. Seem to be connecting here, right? Obviously not pointing it in the right direction. Now, if we move on from those sort of benefit changes, which are, I have to say, in many cases quite painful changes to make unless they are done in the thought of changes for the very long-term future, because they do impact directly on people's retirement income, and they can cause political confusion and debate and anger sometimes that governments are going back on promises that have been made in the past. So as an alternative to that, a number of countries have sought to make what I describe as structural changes, and that is more dramatic changes in the whole structure of social security, with a view perhaps to making it easier to change the future expenditure patterns without directly making reductions in what people perceive to be their pension rights. And these types of structural changes have included a number of countries moving away from the traditional defined benefit social security plan to something which is more on the lines of defined contribution. Debate between defined benefit and defined contribution will be elaborated by Mr. Mohana later on in the conference. But in the context of a social security scheme, defined contribution is seen as relating more closely the benefit which people receive to the contributions which they pay, and therefore perhaps improving the incentives that people have to contribute, because it will directly affect their benefit, and reducing the risk of people trying to avoid paying contributions and playing the system, as happens in some countries, and also perhaps gives people a better understanding of what their accumulated pension wealth might be. However, mostly in the context of national social security schemes, defined contribution does not mean investing money in the stock market, as it might if you had a private defined contribution plan with an insurance company. It is generally operated on the basis of some notional individual accounts. Each individual has an account which is kept for them on a piece of paper or in a computer, and the amount in their account is revalued year by year or month by month in accordance with some formula, for example, relating it to the growth of the price index or to the growth of the economy, the percentage growth in GDP or earnings or some such measure. Now, another aspect of structural reform has been to think, well, maybe it is a good thing to have more funding in the system, and perhaps this will be good for the economy and generally to promote the idea of having some funding rather than relying so much on a pay-as-you-go approach to pension benefits. Other aspects to reform reflect an increasing concern of governments to target their resources more on those who need it, and so perhaps to give more help to the lower paid, perhaps increasing the flat rate element within the scheme, that is, the element which is not dependent on earnings, in order to put more resources to the pensions of those on low incomes than those on high incomes, who, it is argued, are well able to look after themselves through private pension arrangements and other savings. Now, one example of this approach has been in Sweden, which has had a tradition of quite generous social security benefits of a defined benefit nature, and after many years of debate, the Swedish reform, which has now been implemented, has moved the whole social security scheme onto a notional defined contribution approach on the lines I just mentioned, so that each member of the population will now have an individual account based on the contributions that they are paying to social security. Those contributions will be revalued in line with the growth of the economy, and when they get to retirement age, that notional sum available in their account will be turned into an amount of pension by dividing it by an annuity factor, the value of a pension, in order to determine how much pension each person should receive. And that calculation will itself be responsive to the way in which mortality is perceived as changing over the years, so that it will take into account the latest expectation of life at retirement age. And alongside this major change to the social security scheme, there will be greater provision made to encourage complementary pension schemes to grow and prosper. The United Kingdom, I mention as another example of a country that has addressed the issues of pension reform, and although you would see from that earlier slide that the United Kingdom has a quite low level of social security expenditure compared to some countries, nevertheless governments have been concerned about the long-term growth of social security costs, which were implicit in our legislation, and have introduced a succession of reforms or changes which have brought those costs under control. And probably today is not the time to go into a great deal of detail on the United Kingdom system, which is very complicated, but I would perhaps highlight the main features of the reforms that have taken place as being, first of all, in the revaluation of the pension, which was moved from being related to earnings growth to relating it to price growth, which in the long term makes savings, since prices grow, generally speaking, less quickly than earnings over the long term as the economy is growing. Secondly, we saw some changes in our formula for calculating pensions under the earnings-related system, and also an increasing encouragement for private arrangements to develop. And in the United Kingdom, we have this possibility that the private pension funds run by employers or by financial institutions are available for contracting out of Social Security. So you can find people having an option to receive their benefit from Social Security, or on the other hand to build up corresponding benefits in a private plan. And this encouragement of the private sector has meant that more and more of the population have access to a private funded pension plan and rely less and less on the state Social Security for their retirement income. Another facet of the pension reform has been to raise retirement age, although so far this has only affected women by bringing the retirement age for women into line with that for men at the age of 65. I have to say that some European countries have now gone beyond this and have increased retirement age to 67, for example, in some Scandinavian countries like Norway and Denmark. Then we're moving towards some other changes to further encourage private provision by the introduction of something known as stakeholder pensions, which are a particular form of personal pension, which are organized in a more collective way involving the employers and trustees who are responsible for the oversight of the stakeholder pension arrangement. And we have other new legislation proposing what we call now the second state pension or state second pension, which is a further move in the direction of focusing the resources on the lower paid. And it's part of that general tendency to think of Social Security as being more importantly providing for the lower paid and for those who need protection in society, and less as a vehicle for assisting the higher paid, who it is argued should have private provision through their employer or through personal pensions as a means of providing for their own retirement. Now, in another continent altogether, but highly relevant to this debate on Social Security reform, is the country of Chile in South America, which has, since nearly 20 years now, adopted a very strongly funded approach to pension provision by requiring all members of the working population to contribute to funded individual accounts, organized on a competitive basis with a number of different providers, currently around a dozen or so of them, who offer pension arrangements to the population, and the individual can choose which of these to have their pension with, but they have a compulsory requirement to make a contribution to one or other of them. There is still a form of minimum pension guarantee offered by the state, but it's not anticipated that that would have very much effect. Mostly people will get their pension from having paid contributions to funded individual accounts. And this has, in its way, had a great deal of success in Chile and has been promoted by many people, including the World Bank, as a prototype which could be considered in other countries. Part of its success in Chile is due to the fact that the previous Social Security scheme there was in quite bad disarray and was suffering very severe problems both administratively and in terms of contribution evasion by the population. And so the move to a purely defined contribution approach has helped to focus people on the need to make their contribution to their pension plan, because if they don't, they won't get a pension. Also, the performance of the funds in Chile has been remarkably good because of various factors in the Chile market, and that has led to enthusiasm about the returns which can be obtained from this sort of fund. Enthusiasm which I think needs to be tempered when seen internationally, because there are not so many other places in the world where similar high returns would have been achieved by such a system. And there are also criticisms of the Chile system that quite a large proportion of the contributions paid in by individuals get absorbed in the costs of running the system, very largely in marketing costs and advertising and selling, commission to the agents and so on. So something like 25% of the money that people pay in is used in various different ways to cover the costs of the process, and therefore detracts from the amount that people are going to receive from pension in the long term. Well, following to some extent the Chile example, oops, we can go back now. Can't go back now. Following to some extent the Chile example, some Eastern European countries have introduced a mix of the Chile system with some amendments to their existing social security. And one example which I was going to briefly refer to was Poland, where they are maintaining the social security plan that they had before on a pay-as-you-go basis, but reducing the levels of benefits for future employment accrual, and introducing, particularly for younger people and as an option for older people, the possibility of paying into private pension plans as part of their contribution to provide for their old age. Thank you. Now I wanted just to look at some overview of the advantages of going down the route of encouraging complementary pensions. One of these is the perceived advantage of increasing the level of funding in the economy. This is perceived as healthy to the development of capital markets and a good economic situation in the country, to have active investment from pension funds and insurance companies long-term in its perspective, and with a view to providing for the future liabilities in an orderly way. Also, this mechanism of funding in advance for pensions is seen by many people as being a more disciplined approach to providing for the future, rather than saying we'll make some promises and we'll rely on the next generation to pay for them. Surely people argue it's better if you put aside money today to match the promises that you've made, and then you've made provision, as you would in other fields of the commercial and economic situation, you've made provision for the future. Now, it may also, the economists argue, improve efficiency in the labour markets to have a system where people pay for their own pension directly and employers put aside money to pay those costs directly. It avoids some of the fuzziness and uncertainty which arises when those costs are not properly recognised in advance. And also, some would argue that going down this route of encouragement of the private arrangements takes pensions a little bit out of the political arena and makes them less sensitive to big national debate, because they are then dealt with much more at the individual level, the employer and the individual member. And I think there are some quite interesting economic arguments in favour of increasing the level of funding, because it could improve the savings ratio in the economy, could help to develop the capital markets in countries where those are still at an early stage of development. Some people see it as having beneficial effects in terms of meeting the demographic changes that will take place, and also because the investments will have a return associated with them, it could in the long run reduce the costs of making pension provision as compared to the pay-as-you-go basis. Now, there are some counter-arguments, and I don't raise these just to set aside funding as a concept, but simply to try to introduce balance and to avoid people going away thinking, well, funding is the answer to everything, all our problems will be solved if we go that route. Because the saving argument is not wholly satisfactory, in that in many economies, if you force people to save for their pension through a pension plan, they may reduce their saving in other ways. Most people are already aware that they need to have something to live on when they get to retirement, and they may save either through purchasing shares or through putting money into property or in other ways, so that people have mechanisms of saving, and if you force them to save through pension system, then they may adjust their other saving in some ways to compensate. Other issues about the capital markets are that in some countries the capital markets are not really sufficiently well developed to be able to absorb a huge amount of pension fund income, and that may mean that the pension funds have to try to invest in other countries, and that then doesn't really meet the requirement of developing the economy in your own country. And also, if the market is quite small, the impact of a lot of investment from the pension funds may be to push up prices in that market, rather creating a bubble effect, not on the basis of the underlying sustainable earnings of the investments, but on the basis of supply being lower than demand. And also, it's, I think, reasonable to say that ageing will have an impact even on funded pensions, because of the dynamics of people's supply and demand for investments of different types over the years. One can see ways in which a major shift in the demography of the country will have an impact on the prices and returns available from investments. So these, I think, are some of the points I've already made about the demographic situation, that in practice, when you're building up a funded pension system, the investment of those pension funds will help to sustain growth in the market. That's perhaps one of the factors which is leading to the sustained bull market in the United States and in United Kingdom, because there is this continued growth of money which is being put aside for future retirement income. But that situation may change when the baby boomers, this big group of post-war babies, reaches retirement age, when you have a big drawdown on the investment funds that people have made in order to buy annuities, in order to change from a more actively aggressive and risky investment strategy into a more conservative strategy to back retirement income, and that could have an impact on the process of the markets in the next century. Now, other advantages of private pension plans, I think, are less tangible in a way, but perhaps equally important, and that is that people like to be able to identify with their pension rights and their pension wealth, and often find it easier to do that through an occupational pension or a private pension than they do through the Social Security arrangements, which seem a little bit distant and maybe not all that transparent and understandable to them. And one of the things that Social Security schemes can do to respond to this is to try to help people to understand better what their rights are in the Social Security scheme, the value of the pension that they're building up, how much future pension they are becoming entitled to. Nevertheless, the private pension does give the advantage of a sense of ownership. People feel it's their own savings, their own capital, and most private arrangements give more choice to people as to how they arrange their affairs than a public system would, and also more choice and flexibility to employers about organising the remuneration for their employees. Now, when one thinks about the management of a pension plan, the World Bank have tended to argue that there are great advantages of moving towards private management because that will automatically be more efficient and more effective, perhaps. I doubt this as a general concept. It's not clear to me that just by moving from public sector management to private sector management you automatically achieve any efficiency gains. And in fact, it's quite clear in some respects that there are higher costs involved in going by a disaggregated approach. In the United Kingdom, for example, I think our occupational pension plans run by employers are generally quite efficient, but they still cost 2 or 3 times as much to run as the national Social Security scheme in terms of the cost per person of delivering the benefits. And that's simply because they're smaller. They're dealing with perhaps 1,000 people, or even the big ones, 100,000 people, whereas the national scheme is dealing with 20 million people, as the economies of scale are there. Also, when one goes by the private route, there are other risks involved in the process, risks of mismanagement, risks of insolvency perhaps, risks even of fraud, we've seen in some countries, and risk of mis-selling, that is, bad marketing practices in selling things to people which are not quite right for them. So I think one has to, again, have a sense of balance, that there are some advantages of competition. It's very healthy in the economy to have choice and competition, and the involvement of employers and financial institutions in the funded pension sector, I think, is very healthy and important for the economy, but I think it has some downsides in terms of the costs and is not a panacea for reducing the transaction costs in the Social Security system. Now, as far as fund management is concerned, I think there are some possible advantages of some disaggregation. Now, again, it depends on the country, but we have seen some countries where the central management of Social Security funds has caused problems, partly because of the fact that it's a national institution making the investments. That means that it will probably be subject to political direction and intervention to some extent, and also because the size of the organisation and the size of the fund means that the investment transactions it wants to make are so big that they affect the marketplace, and the investments made by a single national pension fund are huge in relation to the size of companies that they want to invest in. So one of the advantages of a more disaggregated private fund management approach is that it does parcel up the investment activity into smaller chunks, means that you can have better liquidity in the market, more market efficiency, and more active management of the assets becomes possible. Well, I think perhaps I'll skip the advantages of defined benefit schemes, as Ibrahim is going to talk extensively on defined benefit versus defined contribution. And I'll finish just with a remark about annuities. Now, annuities are an old concept in the insurance industry. This is where somebody pays a certain premium in return for getting an income for a period. And in this context, the period is usually for the rest of your life. And that's what we call a life annuity. And it's a very basic insurance product, something where the mathematics of it have been understood for 200 or 300 years, and these things are available. Now, one of the problems with this is that if the whole of the population of the country all has to buy annuities, then it's a huge load on the insurance companies. It's not a big problem in the UK or the United States, where insurance companies are very numerous. They have many different products, huge assets invested. But if we focus on countries like Chile, for example, or Mexico, which has also gone down this route of private fund management, when people get to retirement, they all have to buy annuities, subject to some arrangements that they may be able to draw down their money in different ways. But most people buy annuities, and that means that the insurance companies in those countries are now selling more business of the nature of annuities than the whole of the rest of the business they write. And this is then becoming the dominant product in the insurance market. And although it's a product which insurance companies are very much set up to write, it has two main features which make it risky. One is that you don't know how long people are going to live. Maybe you should say that's the job of insurance companies to manage that sort of risk. But this is a sort of generic risk, that if you're insuring millions of people for their pension retirement and mortality is getting better and better, people are living longer and longer, that's going to be quite a tough one for the insurance companies to manage. The other problem is the assets in which they invest. In principle, insurance companies would invest in a whole range of bonds to match the annuities. And if the annuities are linked to inflation, for example, then they would want to invest in bonds which were linked to a price index. But they need to be able to invest in bonds which have a duration of at least 20 or 30 years, maybe even longer, whereas in many countries, perhaps most countries, bonds on the market are generally much shorter in duration than that, and predominantly 10-year or less. So there is a problem of mismatch of investments. Well, some quick conclusions. Conclusions would be that there are advantages of having a mix of systems and having a combination of a pay-as-you-go social security with some funded elements through private pension plans. Private pension plans are not the panacea to solve all problems, but they do have important functions in an economy which make them worth considering and worth trying to develop. But they need to operate under a system of strong regulation, and there needs to be care given to making the costs as low as possible and avoiding these risks of mis-selling and people receiving the wrong type of advice or the wrong type of contract. And they do need a well-functioning capital market, although they themselves contribute to the development of the capital markets. And this problem of annuities means that the insurance industry also has to play an important role in making available the types of annuities which will support the payment of the retirement income. So I think one can draw some lessons from this, that public social security schemes have to think in a wide context about the whole retirement provision of the population. They, in a way, have the overview of what's happening in the whole economy. They need to have a very long-term perspective on what is going on and to try to avoid making promises today which will be regretted tomorrow, and only make changes which can be sustainable in the long term. And hence they need to keep the financial position under regular review and to see how what they are doing interacts with the provision made in the private sector and by public sector employers, and the whole context of the retirement income scenario in the particular country. And I think a decision for governments to make really is how much of the resources that are funneled through social security should be targeted on protection of the less advantaged or the disadvantaged in society and the lower paid, the unemployed perhaps, the disabled, and how much should be more general provision for retirement, or whether that more general provision for retirement, particularly for the better paid, shouldn't be something which is dealt with more specifically through private pension arrangements organised by employers or through insurance companies. Thank you.